Friends, thank you for being here today. What if I told you that the American dream just got repossessed 1.73 million times in a single year? What if the invisible thread holding the working class together has not just frayed, but snapped completely? We're not talking about a statistic buried in some government report. We're talking about the largest wave of vehicle seizures since the 2008 financial crisis, and it's happening right now in real time across every state, every province, every parking lot where families once thought their car was actually theirs. Let me be precise about what we're witnessing. In 2024, American lenders repossessed 1.73 million vehicles. That's not a projection. That's not a fear mongering headline. That is the confirmed data from Cox Automotive and Equifax. And here's the part that should make your blood run cold. This number exceeds every single year since 2009, the year the global financial system nearly vaporized. We are now officially back at crisis level asset seizures, but this time the crisis isn't making headlines. It's happening in the shadows, one tow truck at a time. But this isn't just an American story. In Canada, the contagion is spreading with mathematical precision. In the second quarter of 2025 alone, 1.4 million Canadians missed a credit payment, 90.2% year over year. And auto loan delinquency rates have now surpassed the recession levels of 2009. The silent giant of consumer debt is waking up and it's hungry. Now, you might be thinking this is about bad borrowers, right? People who overspent, overleveraged, made poor choices. Friends, that's what they want you to believe. But here's the counterintuitive reality that shatters that comfortable narrative. It's not just subprime borrowers defaulting anymore. Prime borrowers, the people with good credit scores, stable employment histories, the so-called responsible middle class, they are defaulting at rates higher than before the pandemic. This part is non-negotiable. When the credit-worthy start losing their cars, you're not watching individual failure. You're watching systemic collapse. Let me give you the scale of this trap with a single number, $682. That is the average monthly car payment in America today, a 28% increase in just 5 years. For tens of millions of families, the car payment has become a second rent payment. Think about that architecture for a moment. You're paying rent to live somewhere. You're paying rent to get somewhere. And if either payment fails, the entire scaffolding of your life implodes. And this is where the first domino falls. Without a car, you cannot get to work. Without work, you cannot make the mortgage payment. Without the mortgage payment, you lose the house. The vehicle isn't just transportation, it's the linchpin of economic survival for the working class. And right now, that linchpin is being systematically removed from 1.73 million households. Here's what I call the big secret of the entire system. This was designed to fail, not by accident, not through negligence, by design. Let me show you the mechanism hiding in plain sight. We need to go back to understand how we arrived at this mathematical endgame. This isn't a story that starts in 2024. This is the final act of a tragedy that began the moment the financial system learned nothing from 2008. In 2008, it was housing. Predatory lenders extended mortgages to anyone with a pulse, packaged those loans into securities, sold them to pension funds and foreign governments, and when the default started, the entire global financial system seized up like an engine without oil. We were told that lessons were learned, that regulations were put in place, that this time would be different. But here's the part nobody expects. The exact same playbook was deployed again, just with a different asset class. Instead of houses, they targeted cars. Instead of subprime mortgages, they engineered subprime auto loans. And instead of learning from history, the financial architects simply changed the stage and ran the same con. Here's how the trap was set. In the years following 2008, interest rates were driven to historic lows. Cheap money flooded the system, and the auto industry, desperate to move inventory, partnered with lenders to extend loan terms to absurd lengths: 84 months, 96 months, some loans stretching nearly a decade. Let me cut through the noise. You were being offered an 8-year loan on a depreciating asset that would be worth half its value in 4 years. The pitch was seductive. Lower monthly payments, affordable financing, drive away today. But here's the mechanism they never explained. By stretching the loan term, they trapped you in negative equity almost immediately. The car loses value faster than you pay down the principal. Within 2 years, you owe more than the car is worth. You're underwater before you even realize you're drowning. And this is where the system reveals its most crucial secret, which connects directly to what's happening right now in those repo lots. The lenders knew this would happen. They counted on it because when you default, and the math guaranteed that millions would default, they don't lose. They repossess the car, sell it at auction, and then come after you for the difference between what you owed and what they recovered. It's a churn machine designed to extract wealth from the working class in perpetuity. Let me show you what actually happened behind the curtain. The lending wasn't coming from traditional banks with strict underwriting standards. It was coming from what we call shadow banks, monoline lenders, dealer finance companies, entities that operate outside the traditional regulatory framework. These shadow lenders have delinquency rates as high as 16.6%. They specifically target vulnerable borrowers, charge interest rates of 25% or higher, and when the loan inevitably fails, they seize the asset and start the cycle again with another desperate buyer. This is not a conspiracy. It is a stated business model, and it is mathematically devastating. Now, here's where everything changes. In 2025, three forces converged with the precision of a controlled demolition. Force one: interest rates spiked. The Federal Reserve, trying to combat inflation, raised rates aggressively. Force two: vehicle prices, which had been inflated to ridiculous levels during the pandemic supply chain crisis, started to fall. Force three: the cost of living crisis intensified. Rent, food, energy, everything essential became more expensive, squeezing household budgets from every angle. And this is where the cascade becomes unstoppable. The borrower who took out that 96-month loan in 2021, when rates were low and car prices were at their peak, suddenly found themselves in an impossible situation. Their monthly payment, which seemed manageable at 3% interest, is now unaffordable. The car they bought for $45,000 is now worth $28,000 on the used market. They owe $38,000 on the loan. They are $10,000 underwater with no way out. If they try to sell the car, they still owe the bank thousands. If they keep the car, they can't make the payments. And if they default, the repo man comes, the car gets auctioned for pennies on the dollar, and they're still on the hook for the deficiency balance, plus the credit score destruction that makes it impossible to borrow for anything else. This is the negative equity trap, and it has ensnared tens of millions of households. But that's not the real problem. Here's the part the experts gloss over. These auto loans don't just sit on bank balance sheets. They get packaged into securities called asset-backed securities, or ABS. Pension funds buy them. Insurance companies buy them. Foreign investors buy them. The entire financial system is interconnected through these instruments, just like it was with mortgage-backed securities in 2008. Let me be precise. When delinquency rates spike, and they are spiking right now, the value of these ABS products craters. The institutions holding them take losses. They pull back on lending, credit tightens, and the contagion spreads from the repo lot to the bond market to the broader economy. We haven't even reached the breaking point yet. Here's what that looks like on the ground. And this is where the abstraction becomes devastatingly real. Let's talk about who is actually losing their cars, because the demographic data reveals a collapse that the official employment numbers are deliberately hiding. Generation Z, the youngest workers, the ones who need mobility the most to access entry-level jobs, to build their careers, to establish economic independence, they are defaulting at the fastest rate of any age cohort. These aren't people buying luxury vehicles. These are 23-year-olds who financed a used Honda Civic at 18% interest because it was the only way to get to their warehouse job, their retail shift, their gig economy hustle. And now, with that car repossessed, they're not just losing transportation, they're losing their foothold in the economy entirely. But this isn't even the part that scares me. The truly alarming signal is coming from the so-called prime and near prime borrowers. These are people with credit scores above 650, with documented income, with what the system classifies as low risk, and they are defaulting at rates that exceed pre-pandemic levels. Let me show you what this means. The middle class is breaking in real time. This is not theoretical, it's observable. When credit-worthy borrowers with stable employment start losing their cars, you're not witnessing individual financial mismanagement. You're witnessing the slow-motion collapse of purchasing power, the erosion of real wages, the grinding destruction of household balance sheets under the weight of inflation that refuses to be acknowledged in official statistics. And here's where the domino we just tipped starts to knock over everything else. The car is always the first asset to go. It's the easiest for lenders to repossess, the quickest to liquidate, the most visible signal of financial distress. But once the car is gone, what follows is mathematically predictable. Ontario provides the forensic evidence of this cascade. Mortgage delinquencies in that province have exploded, not by 10%, not by 20%, but by 90.2% year over year. This is the crack that becomes an earthquake. The same households that lost their vehicles 6 months ago are now missing their mortgage payments. The same working families that got pushed out of car ownership are now being pushed out of home ownership. This part isn't a prediction, it's math. Without a car, you cannot maintain the job that pays the mortgage. Without the job, the mortgage fails. Without the mortgage, the house enters foreclosure. The financial system, in its infinite wisdom, has engineered a perfect storm of sequential asset seizures. And this is vanishing in real time. We're not talking about projections for 2026 or 2027. The repossession wave of 2024 is already flowing into the mortgage delinquency spike of 2025. The housing crisis isn't coming, it's here. It's just moving through the system at different speeds across different asset classes. Now, let me address the question you're asking right now. If this is so catastrophic, why isn't it making headlines? Why are we still hearing about soft landings and resilient consumers and strong labor markets? Here's the detail even analysts tend to miss. The official unemployment rate is a lagging indicator. It measures people who lost their jobs last month and filed for unemployment insurance. But the repo crisis is a leading indicator. It measures people who are about to lose their jobs because they can no longer get to work. The repo lot tells you what the unemployment office will confirm 6 months from now. This is where common sense actually becomes your enemy. You look at the official numbers, unemployment at 4%, job creation still positive, GDP growth holding steady, and you think the economy must be fine. But those numbers are backward looking. They're telling you where we were, not where we're going. The repo data is forward looking. It's telling you that 1.73 million households just lost their primary means of economic participation. It's telling you that the working class infrastructure is being dismantled, one VIN number at a time. And it's telling you that the employment numbers are about to turn catastrophically negative as those repossessions filter through to job losses, which filter through to mortgage defaults, which filter through to economic contraction. This was inevitable the moment the Federal Reserve started raising rates, while household debt was at record highs and real wages were stagnant. The mathematics were non-negotiable. You cannot service expensive debt with eroding income. The system was designed to extract. The borrowers were designed to fail. Let me show you the part they're not telling you about the lending side. When we say 1.73 million repossessions, we're talking about the visible tip of a much larger iceberg. For every car that actually gets repossessed, there are 3 or 4 more borrowers who are technically in default but haven't been processed yet. There are millions more who are 60 days late, 90 days late in that gray zone before the repo company gets the order. The data forces one conclusion. The official delinquency rate of 8% is understating the crisis. The real distress rate is closer to 20 to 25% when you include borrowers who are late but not yet repossessed, borrowers who are making minimum payments by skipping other bills, borrowers who are one emergency away from default. And here's where everything we've discussed converges into a singular point of failure. These auto loans, these millions of deteriorating debts, they're not isolated. They're woven into the financial system through those asset-backed securities I mentioned earlier. Pension funds in Canada hold these securities. Insurance companies in Europe hold these securities. Retirement accounts hold these securities. When the underlying loans start to fail, and they are failing right now, the value of those securities craters. Suddenly, your pension fund isn't worth what the statement says it's worth. Your insurance policy is backed by assets that are evaporating. The retirement you thought was secure is sitting on top of a portfolio stuffed with defaulting auto loans from borrowers in Ontario and Michigan and Texas who can no longer afford their $682 monthly payment. This is the moment the clock actually starts, not when the car gets repossessed, not when the borrower defaults, but when the securities that are built on top of those loans start to crack and the institutional investors start to realize they're holding toxic paper. Let's cut through the noise about what happened in 2008 versus what's happening now. In 2008, it was mortgage-backed securities that brought down Lehman Brothers, that froze credit markets, that required trillions in bailouts. The system was interconnected through housing debt. Today, the system is interconnected through consumer debt, auto loans, credit cards, personal loans. The mechanics are identical. The scale is comparable. The only difference is the asset class. And here's the counterintuitive reality. Auto loans might actually be more dangerous than mortgages. Why? Because you can live in a house during foreclosure for 12 to 18 months while the process grinds through the courts. You have time, you have options, but when your car gets repossessed, it happens in 24 hours. You wake up and it's gone. There's no grace period, no lengthy legal process, just immediate total loss of mobility. And here is where the breaking point becomes visible. The economy is not an abstraction. It's not GDP numbers and inflation rates. It's people getting to work. It's goods getting delivered. It's services getting performed. And all of that requires transportation. When you start removing vehicles from 1.73 million households, you're not just affecting those families. You're affecting their employers, their supply chains, their customers, their communities. For the average household, this means you're one car breakdown away from economic catastrophe. For small businesses, this means your employee base is becoming less reliable because they can't get to work. For the broader economy, this means productivity is about to fall off a cliff because the working class is being systematically demobilized. They say employment is strong, but if employment is so strong, why are prime borrowers losing their cars? Why are mortgage delinquencies spiking? Why are repo lots filled to capacity with late model vehicles? The answer is simple. Employment isn't strong. Real purchasing power is collapsing. The official metrics are lying to you, or at best, telling you a story about yesterday while today is already burning, and this part has already begun. We're not warning about a future crisis. We're documenting a current crisis that the mainstream narrative refuses to acknowledge. Now, let me take you inside the mechanism that makes this crisis truly inescapable. Because what we're witnessing isn't just a surge in defaults, it's the exposure of a predatory infrastructure that was built specifically to extract wealth from those who can least afford to lose it. The shadow banking system, these monoline lenders, these dealer finance companies operating outside traditional regulatory oversight, they're not in the business of helping people buy cars. They're in the business of debt cycling. Here's how it works, and this is the part the official reports never discuss. A borrower with a 580 credit score walks into a dealership. They need a car to get to work. The traditional banks won't touch them. But the dealer has a relationship with a subprime lender, a shadow bank that specializes in high-risk loans. The borrower gets approved instantly, but at 24% interest on a 7-year loan for a vehicle that's already overpriced by 30%. The lender knows the borrower will likely default within 3 years. They've run the models, they've seen the data. But here's the genius of the scam: they don't care. Because when the borrower defaults, they repossess the car, sell it at auction for 60% of the loan value, and then pursue the borrower for the deficiency balance. The borrower ends up destroyed financially, credit ruined, wages garnished, bankruptcy on the horizon. And the lender, they move on to the next vulnerable person and run the same cycle. The delinquency rate at these shadow lenders is 16.6%. More than double the industry average. This is not a bug. This is the feature. They are not trying to minimize defaults. They are harvesting defaults. It's a churn machine designed to perpetually extract from the bottom of the economic pyramid. And here's where, once this shifts, everything above it starts to shake. Because these shadow banks don't keep all the risk on their books. They package these subprime loans into securities and sell them to institutional investors who are desperately searching for yield in a low-interest environment. Pension funds in Toronto, insurance companies in Frankfurt, retirement accounts in California. So when these loans start failing en masse, and they are failing right now, the losses don't stay contained in the shadow banking system. They metastasize through the entire financial architecture. A repo in Detroit becomes a write-down at a pension fund in Ontario. A default in Phoenix becomes a loss at an insurance company in Munich. This is where the countdown quietly began, not in 2024 when the repossessions spiked, but in 2019 and 2020, when these loans were originated at the peak of vehicle prices with absurdly extended terms. The crisis was baked in the moment the contracts were signed. We're just now seeing the inevitable maturation of those bad debts. Let me be precise about the convergence we're facing. This isn't a single crisis. It's 3 interlocking crises hitting simultaneously, and the combined impact is exponentially more destructive than any one of them in isolation. Force 1, the interest rate shock. The Federal Reserve raised rates from near zero to over 5% in less than 2 years. Every single borrower with variable rate debt or anyone trying to refinance got crushed. Monthly payments exploded. Debt service costs became unsustainable. Force 2, the vehicle price collapse. During the pandemic, supply chain disruption sent car prices to absurd heights. A 3-year-old used truck that sold for $25,000 in 2019 was selling for $45,000 in 2022. Borrowers financed at the peak. Now those vehicles are worth $30,000 and the borrowers still owe $40,000. They're trapped in negative equity with no exit. Force 3, the cost of living crisis, rent, groceries, energy, insurance, every essential expense has surged. Household budgets that were tight in 2021 are now impossible in 2025. Something has to break. And the first thing that breaks is the car payment, because you can survive without a car for a few weeks. You can't survive without food or shelter. These three forces converging is not a coincidence. It's the structural outcome of a decade of monetary policy that inflated asset prices, encouraged reckless lending, and destroyed the purchasing power of working class wages. This was the inevitable endgame the moment the first domino was set up. And once this shifts, the cascade becomes unstoppable. The repo crisis feeds the unemployment crisis. The unemployment crisis feeds the housing crisis. The housing crisis feeds the banking crisis. And the banking crisis feeds the broader economic collapse. But here's the part nobody expects. And this is where we need to shift from mechanics to psychology, because the greatest danger you face right now isn't what's happening in the economy. It's what's happening in your mind. Human beings are hardwired to believe tomorrow will look like yesterday. It's called normalcy bias, and it's the cognitive trap that has destroyed more wealth, ruined more lives, and shattered more futures than any market crash ever could. You see the headlines about repossessions, and part of your brain says, that's happening to other people, not me. I'm careful. I'm responsible. You see the delinquency data and you think the system has survived worse. They'll find a way to fix this. You see the warning signs and you file them away as noise, as fear-mongering, as something to worry about later. This is where common sense becomes your enemy, because normalcy bias whispers it's always been fine before. And what it doesn't tell you is that history is littered with people who thought exactly that, right up until the moment their world collapsed. In 2007, millions of American homeowners believed housing prices would never fall. They had decades of data showing consistent appreciation. They had experts telling them real estate was the safest investment. They had normalcy bias telling them tomorrow would look like yesterday. And then 2008 arrived and they lost everything. We are at that moment again. The only difference is the asset class. The warning signs are flashing red. The data is screaming. The mechanism of collapse is visible. But normalcy bias is still operating in the minds of millions, telling them, this time it's different. This time we'll be fine. Let me show you the other psychological trap operating right now, the money illusion. You look at your bank account, your investment portfolio, your 401k statement, and you see numbers. Those numbers might be higher than they were 5 years ago. You might even feel wealthier on paper. But here's the mechanism hiding in plain sight. The numbers are lies. You become a millionaire on paper, but poorer at the grocery store. Your portfolio shows gains, but your purchasing power has evaporated. The currency itself is being debased, and the nominal increases in your account balance are camouflaging the real decrease in your wealth. This is not theoretical. The data forces one conclusion. If your net worth increased 30% in the last 5 years, but the cost of essentials increased 40%, you're not wealthier, you're poorer. The money illusion tricks you into thinking you're winning when you're actually losing ground. And here is where we arrive at the binary choice that will define whether you survive or get crushed by what's coming. The question isn't whether there will be a crisis. The crisis is already here. It's unfolding in repo lots and foreclosure auctions and delinquency reports. The question is, what side of the crisis will you be on? Do you own assets or do you own claims on assets? This is the fundamental distinction that separates security from catastrophe. If you own stocks, you own a claim. If the company fails, your claim is worth zero. If you own bonds, you own a claim. If the borrower defaults, your claim becomes a lawsuit. If you own dollars in a bank account, you own a claim. If the purchasing power of that currency collapses, your claim buys you nothing. But if you own physical assets, land, commodities, precious metals, you own reality, not a claim on reality, not a promise of reality, actual reality that cannot be vaporized by a default, a bankruptcy, a currency debasement. This is where the great separation happens. In every financial crisis, wealth doesn't disappear, it transfers. It moves from claims to assets, from paper to physical, from the unprepared to the prepared. Gold and silver are not investments in this framework. They're not speculative trades. They're exits from the system. When you convert paper claims into physical metal, you're stepping out of the line of fire. You're removing yourself from the daisy chain of counterparty risk that runs through every bank, every brokerage, every financial institution. The system operates on the assumption that not everyone will demand their money at the same time. It's a confidence game. And when confidence breaks, when the repo crisis becomes a banking crisis, becomes a currency crisis, the people holding paper claims discover that there's nothing behind them. Here's what that looks like on the ground when this plays out. The bank tells you your account has a balance of $50,000, but when you try to withdraw it, there are limits, restrictions, delays, because the bank doesn't actually have $50,000 sitting in a vault with your name on it. They lent it out 10 times over. Your deposit is just a number on a screen, a promise that breaks the moment too many people ask for their money simultaneously. But the person who converted that $50,000 into physical gold 2 years ago, they hold the metal in their hand. No counterparty risk, no bank dependency, no digital claim that can be frozen or confiscated or devalued with a keystroke. This is not a conspiracy. It is a stated reality of how fractional reserve banking operates. Your deposits are their liabilities. Their loans are their assets. And when those loans fail, when the auto loans default, when the mortgages foreclose, when the credit cards charge off, the bank's assets evaporate, but their liabilities to you remain the same, except now they don't have the money to pay you. And this is the moment small businesses get crushed, pensions get wiped out, and savings accumulated over decades disappear into the void. We don't have months. This is happening in days. The repo data from 2024 is hitting financial statements in early 2025. The mortgage delinquencies from the first quarter of 2025 will hit bank balance sheets in the third quarter. The cascade is already in motion. The timeline is shrinking. So here's the choice in its starkest terms. Do you want to hold a bank-owned liability, a car financed at 18%, a house mortgaged to the limit, a portfolio of stocks that are claims on companies drowning in debt? Or do you want to own assets that have no counterparty, that exist independent of the financial system, that have preserved wealth through every currency collapse, every banking panic, every sovereign default in human history? For pensions, this is catastrophic. For retirement accounts stuffed with ABS securities backed by defaulting auto loans, this is catastrophic. For anyone whose wealth is a digital claim on a system that's cracking in real time, this is catastrophic. But for those who understand what's happening, who see the repo crisis for what it actually is, the early warning system for a much larger collapse, this is the moment to act. History favors the prepared, and the window for preparation is closing, not in years, not in months, in weeks, because once the broader public realizes what the repo data is signaling, once the mortgage defaults start making headlines, once the banking sector starts showing strain, the exits will be crowded. The premiums on physical assets will spike. The ability to convert paper into reality will evaporate. The liquidity tide is going out, and we are about to find out who is swimming naked. Friends, 1.73 million families just discovered they didn't own their cars. The bank did. Millions more are about to discover they don't own their homes. The mortgage company does. And eventually, we're all going to discover we don't own our currency. We just hold claims on a monetary system that's being debased into irrelevance. The Great Repossession isn't just about cars. It's about the systematic seizure of working class wealth, the transfer of assets from the many to the few, the exposure of a financial system built on fraud and sustained by confidence alone. The question is whether you'll be on the side holding real assets when the illusions finally shatter, or whether you'll be holding paper claims when the system admits it can never make good on its promises. The data is clear, the mechanism is visible, the timeline is shrinking. What you do with that information will define everything.